Most people think about taxes once a year, scrambling to gather receipts and file before the deadline. But what if you could approach your taxes proactively? Tax planning is not just about minimizing what you owe, it's about keeping more of your hard-earned money and reaching your financial goals faster. Ignoring tax planning is like leaving money on the table. By understanding the tax code and utilizing available strategies, you can significantly reduce your tax burden. Don't let confusion or procrastination stand in your way. This guide will empower you with the knowledge and tools to take control of your taxes and maximize your savings in 2025. Get ready to unlock the secrets of smart tax planning. Saving for retirement is crucial. It's never too early or too late to start planning for your future. Whether you're just beginning your career or nearing retirement, making the right financial decisions now can have a significant impact on your quality of life later. Your future self will thank you. Imagine the peace of mind you'll have knowing that you've taken steps to secure your financial future. The joy of a comfortable retirement is within reach if you plan wisely. One of the most powerful ways to grow your retirement nest egg is through tax-advantaged accounts like 401(k)s and IRAs. These accounts offer significant benefits, including tax-deferred growth, which can help your savings compound over time. The good news is that the contribution limits for these accounts are increasing in 2025. This means you can save even more for your retirement, taking full advantage of the tax benefits these accounts offer. For 401(k) plans, the contribution limit is $22,500, up from $22,000 in 2024. This increase allows you to put away more money each year, boosting your retirement savings. If you're age 50 or older, you can contribute an additional $7,500 as a catch-up contribution. This is a great opportunity for those who may have started saving later or want to maximize their retirement funds. For IRAs, the contribution limit is $7,000, up from $6,500 in 2024. This increase provides more room to grow your retirement savings in these tax-advantaged accounts. Those aged 50 or older can contribute an additional $1,000 as a catch-up contribution. This allows older savers to make up for lost time and ensure they have enough funds for a comfortable retirement. Take advantage of these increased limits. By contributing the maximum amount, you can significantly enhance your retirement savings and take full advantage of the tax benefits. Contributing the maximum amount allows your money to grow tax-deferred, meaning you won't pay taxes on your earnings until retirement. This can result in substantial growth over time, giving you a larger nest egg when you need it most. It's a smart way to supercharge your retirement savings. By making the most of these increased contribution limits, you can ensure a more secure and enjoyable retirement. Start planning today and give yourself the gift of financial peace of mind. Investing always involves some level of risk. Whether you're a seasoned investor or just starting out, the ups and downs of the market are inevitable. While we aim for profits, losses can occur. These losses can be disheartening, but they don't have to be entirely negative. But did you know that you can use those losses to your advantage come tax time? This is where the concept of tax loss harvesting comes into play. Tax loss harvesting is a strategy that involves selling losing investments to offset capital gains realized from profitable investments. Essentially, it allows you to turn a negative into a positive. By offsetting gains with losses, you can reduce your overall tax liability. Here's how it works. Suppose you sold some stocks for a profit of $5,000. This profit would typically be subject to capital gains tax. You also have other stocks that have lost $3,000. These losses can be used to your advantage. By selling the losing stocks, you can offset $3,000 of your gains, reducing your taxable income by that amount. This means you only pay taxes on the remaining $2,000 of profit. Tax loss harvesting can be a powerful tool for investors looking to minimize their tax burden. It not only helps in reducing taxes, but also in rebalancing your portfolio. It's important to consult with a financial advisor to determine if this strategy is right for your individual circumstances. They can provide personalized advice and help you navigate the complexities of tax laws. Roth IRAs offer unique tax advantages, particularly during years when your income is lower than usual. Unlike traditional IRAs where contributions may be tax-deductible but withdrawals in retirement are taxed, Roth IRA contributions are made with after-tax dollars. This means that qualified withdrawals in retirement are completely tax-free. Converting a traditional IRA to a Roth IRA can be especially beneficial during low-income years. When you convert a traditional IRA to a Roth IRA, you'll owe taxes on the amount converted. However, if your income is low, you may be in a lower tax bracket, resulting in a smaller tax liability. Additionally, by paying taxes up front, you can enjoy tax-free withdrawals in retirement, potentially saving you thousands of dollars over the long run. If you anticipate being in a higher tax bracket during retirement, a Roth IRA conversion could be a strategic move. Section 5. Itemized versus standard deductions. Choosing the best option for you. When filing your taxes, you have the option of taking either the standard deduction or itemizing your deductions. This decision can significantly impact the amount of tax you owe or the size of your refund. The standard deduction is a fixed amount that reduces your taxable income, making it simpler and quicker to file your taxes. It's a straightforward option that doesn't require you to keep track of every deductible expense throughout the year. On the other hand, itemized deductions allow you to list specific expenses that can be deducted. This method can be more time-consuming, but may result in greater tax savings if your deductible expenses are substantial. The best option for you depends on your individual circumstances. Factors such as your income, expenses, and financial goals should all be considered when making this decision. The standard deduction is generally simpler and may be more beneficial if you have fewer deductible expenses. It can save you time and effort, especially if your financial situation is straightforward. For 2025, the standard deduction is $14,700 for single filers. This amount is adjusted annually to account for inflation and changes in tax laws, and $29,400 for married couples filing jointly. This higher amount reflects the combined income and expenses of two individuals. Itemizing deductions may be advantageous if you have significant expenses in certain categories, such as mortgage interest, state and local taxes, medical expenses, or charitable contributions. These deductions can add up and potentially exceed the standard deduction. Carefully consider your options and choose the deduction method that minimizes your tax liability. Consulting with a tax professional can also provide valuable insights tailored to your specific situation, ensuring you make the most informed decision. Section 6. Charitable giving. Maximize your deductions and impact. Giving back to causes you care about is not only personally rewarding, but can also provide tax benefits. When you make charitable donations, you may be eligible to deduct a portion of your contributions from your taxable income. To qualify for a deduction, your donations must be made to eligible organizations such as registered charities. Keep accurate records of your donations, including receipts and acknowledgement letters. The amount you can deduct depends on the type of donation and your adjusted gross income. For cash donations, you can generally deduct up to 60% of your AGI. For non-cash donations such as clothing or household items, the deduction limit is generally 30% of your AGI. Section 7. Education credits and deductions. Saving for your future or your children's. Investing in education is an investment in your future. The good news is that there are tax breaks available to help offset the costs of higher education. Two of the most valuable tax benefits are education credits and deductions. Education credits, such as the American Opportunity Tax Credit and the Lifetime Learning Credit, can directly reduce your tax liability dollar for dollar, up to a certain amount. These credits have income limitations and other requirements, so it's essential to check your eligibility. Education deductions, such as the student loan interest deduction, allow you to deduct a portion of your qualified education expenses from your taxable income. Take advantage of these tax benefits to make education more affordable. Section 8. Homeownership benefits unlocking tax savings for homeowners. Owning a home comes with various expenses, but it also offers potential tax advantages. One of the most significant tax breaks for homeowners is the mortgage interest deduction. This deduction allows you to deduct the interest paid on your mortgage, which can result in substantial savings over the life of your loan. Additionally, you may be able to deduct property taxes you paid on your primary residence. Other potential tax benefits for homeowners include deductions for energy-efficient home improvements and capital gains exclusions when you sell your home. Be sure to explore all available tax breaks to maximize your savings as a homeowner. Section 9. Putting it all together. Building your winning tax strategy. Tax planning is not a one-size-fits-all endeavor. The best approach for you will depend on your individual circumstances, financial goals, and risk tolerance. Start by educating yourself about the tax code and available strategies. Consider seeking guidance from a qualified financial advisor or tax professional who can provide personalized advice. Stay organized throughout the year, keeping track of your income, expenses, and investments. Review your tax situation periodically and make adjustments as needed. By taking a proactive and informed approach to tax planning, you can minimize your tax liability, keep more of your hard-earned money, and achieve your financial goals faster.